Banks are very important in managing the world's money, helping us save our money and giving loans when we need them. But banks have some secrets they don't always share with us. Today, we're going to reveal 5 secrets about banks. Understanding these can help you make better financial decisions, as banks often profit from our lack of knowledge. 1. Money in the bank makes you poor. People often think that saving money in a bank is a great idea, much better than keeping it hidden at home. And it seems right, because banks pay you interest, which should help your money grow. But in reality, this isn't what happens. And here's why. Let's talk about how much things cost. For example, a hamburger from McDonald's cost about $3 in the 1990s, but now it costs $5 to $80. So, the $3 you had back then can't buy as much today. This increase in prices over time is called inflation. If we say inflation is about 4 or 5% each year, then the interest from your bank should be at least that much to make sure your money can still buy the same things it could 10 years ago. However, most of us notice that things like gas and milk are more expensive, and we've had to reduce our spending to manage our budgets. This shows that the money in our bank accounts isn't keeping up with how fast prices are rising. Banks usually give about a 3% interest rate on savings. But if inflation is 4%, you're actually losing about 1% of your money's value every year. So, leaving your money in the bank without doing anything else isn't a good idea if you want to keep your lifestyle or improve it. A better approach is to invest your money in things that might increase in value faster than the rate of inflation. Investing in stocks, real estate, or even safer options like government securities can offer better returns and help protect your money from losing value over time. 2. Your bank balance might mislead you. We often feel secure when we check our bank balances, believing that the money shown is ready for us whenever we need it. But the truth is a bit more complicated because of a banking rule called the fractional reserve system. Under this system, banks don't actually keep all of your deposited money. Instead, they are required to keep only a small fraction of deposits as reserves, as set by the central bank, like the Federal Reserve in the US. For instance, if you deposit $1,000 into your bank account and the reserve ratio is 10%, the bank holds on to $100 and is free to lend out the remaining $900. This $900 then goes into someone else's bank account, and that bank can again lend out 90% of those funds. This process repeats, magnifying the amount of money circulating in the economy from your initial deposit. From your original $1,000 deposit, with a 10% reserve ratio, the banking system can effectively create up to $10,000. This happens because each new deposit created by a loan can be re-lent, except for a small required reserve. This seems like creating money out of nowhere, which banks can do based on the assumption that not everyone will withdraw their money at the same time. This assumption helps banks manage their funds and make profits, but can lead to issues if too many people try to withdraw their money simultaneously. For example, during the 2008 financial crisis, and again in 2023 with the collapse of Signature Bank, too many people tried to withdraw their deposits all at once, causing massive problems. These events show how fragile the system can be when panic sets in. 3. Low risk equals cheaper loans. Ordinary people typically borrow money when they need it because they don't have enough cash on hand. Wealthy individuals, however, might borrow even when they have plenty of money. This is because the wealthier you are, the less it costs to borrow money. This might sound strange, but it's based on how banks assess risk. Banks are in business to make money, but they are very cautious about risk. If someone has a lot of debt, like high credit card balances, banks see them as a high-risk borrower and charge higher interest rates to offset this risk. On the other hand, wealthy people like Mark Zuckerberg are seen as low risk because they have plenty of assets and are less likely to default on loans. As a result, banks offer them loans at much lower rates. In 2012, for example, while the typical mortgage rate was about 2.69%, Zuckerberg managed to secure a mortgage rate of just 1.05%. This difference might seem small, but over the life of a large loan, it adds up significantly. On a $5.95 million loan, this lower rate saved Zuckerberg nearly $96,580 each year. Over a 30-year term, this adds up to nearly $3 million in savings, demonstrating how much cheaper loans can be for the wealthy and illustrating the significant advantages that come with lower borrowing costs. 4. Debt, a tool for the wealthy. Debt is often seen as something negative, but for rich people, it can actually help them get richer. Let's look at Mark Zuckerberg's example to understand this better. Even though Zuckerberg was already a billionaire with a net worth of $15.7 billion, he decided to take out a loan. You might wonder why someone so wealthy would need to borrow money. The reason is that smartly using debt can bring many financial benefits. Zuckerberg took out a loan at a low interest rate of 1.05% and invested this money in an index fund that returned about 8%. By doing this, he was making a profit from the difference in interest rates, essentially earning about 7% profit on borrowed money. This method of using borrowed money to invest and earn a higher return than the cost of the loan is a clever way to use debt to increase wealth. Moreover, the loan helped Zuckerberg save on taxes, allowing him to keep even more of his money. This shows that if you understand how to use debt wisely, it can actually act more like free money. It helps you make more money than the debt costs you, especially when you also get tax benefits. If you're interested in learning more about leveraging debt to build wealth, consider reading Robert Kiyosaki's best-selling book, Rich Dad, Poor Dad. These resources can provide deeper insights into how to use debt as a powerful tool in your financial strategy, and why credit cards benefit banks more than you. Think twice if you believe bank representatives are just trying to help when they offer you a credit card. They're often motivated by hitting sales targets, not by your financial well-being. If a bank rep seems extra friendly, be cautious. It could be a red flag. While banks earn a lot from credit cards, these pieces of plastic can be detrimental to your financial health. Here are a few reasons why credit cards often benefit banks at your expense. 1. Very high interest rates. Among all types of borrowing, credit cards usually come with the highest interest rates, which can reach as high as 20%. If you manage to pay your full balance on time every month, you won't have to worry about these rates. However, not many people do this. A survey by LendingTree in 2023 found that Americans have a total of $986 billion in credit card debt, and about 65% of cardholders don't pay off their full balance each month. This leads to accumulating debt that can quickly spiral out of control because of high interest. 2. Transaction processing fees. Another way credit cards cost you money is through transaction processing fees. Every time you use a credit card, the merchant pays a fee to the bank, which can be up to 15% of the transaction amount. Most merchants pass this fee on to customers by increasing their prices. So, if you buy something for $100, up to $15 of that price could be covering the credit card processing fee, making everything you buy more expensive. 3. Changing terms. Banks can also increase interest rates on credit cards with just 15 to 30 days notice. Once this period is over, the new rates automatically apply. Most people don't read the detailed terms and conditions of their credit card agreements, so they might not even be aware of these changes until they see their bill. Credit cards also make it too easy to spend money because they delay the moment you have to pay. This often leads us to forget about checking if we can really afford what we're buying, which encourages overspending. This delayed payment feature, while convenient, can lead to significant financial problems over time as debt accumulates. If you want to avoid falling into a debt trap, be cautious with how and when you use credit cards. Make sure to keep track of your spending and try to pay off your balance in full each month to avoid interest charges. If you found this explanation helpful, please like and subscribe to our channel for more insights into managing your finances wisely. Our videos aim to help you understand more about personal finance and how to navigate the potential pitfalls of products like credit cards.